It's my pleasure to be up here with three very distinguished gentlemen, all three active in the capital markets. I thought I'd start us out with a little bit of a reflection on Fred Hu's remarks this morning, and that to sort of set the stage for the conversation that will follow with Paul and Lito and Fukazawa-san. Fred this morning talked about the last few months being nothing short of breathtaking with what would the impact on global finance and the world economy. And that impact is still being felt to varying degrees in various parts of Asia. This time, as opposed to 1997, 1998, the fundamentals are in place to position the economies for a stronger recovery. And that has led many to conclude that that the emerging markets, particularly in Asia, hold the key to recovery. And the question still is out there, though, do they? Fred noted that it's a fragile recovery, imbalances remain, and what booms can indeed bust. Each of the three gentlemen were asked beforehand to think about three questions and then to offer their perspectives as an investment banker, as a private investor, or private equity investor in domestic markets, and as a sovereign fund or institutional investor. And the three questions were, what is the outlook for Asia generally and the financial markets specifically? How has that outlook shaped your investment strategy or your advice for investments? And how has that outlook shaped your approach to risk? So I'm going to ask each three to comment for a few minutes to offer their perspectives on those three points. And then we'll go to the audience. And I'm going to really try to engage some of you, not have the panelists do all the heavy lifting, but indeed to bring some of you your comments forward if I can. Let me introduce the three first, and then we'll listen to what they have to say, and then we'll go to all of you. Jose Isidro Camacho, introduced to me as Lito, is the vice chairman for Asia Pacific region at Credit Suisse, based in Singapore. Lito served as the Ministry of Finance and also the Minister of Energy as well for the Philippines. So he has a long and distinguished career in banking as well as government service. And to my left is Paul Costello, who is the general manager of the Future Fund, a $58 billion assets under management sovereign fund established in 2006 to help superannuation funds meet their liabilities as the population of Australia ages. He was the founding CEO of the New Zealand Superannuation Fund, and before that, chief executive of Superannuation Trust of Australia, also a long and distinguished career. Fukazawa-san, to my far left, is president and managing partner of Tokyo Marine Capital, based in Tokyo. He has a broad background in corporate finance, and with previous positions with Mitsuo Securities, Industrial Bank of Japan, and the former long-term credit bank, now Shinsei Bank. So we have an investment banker, a private equity investor, and a sovereign wealth fund manager. So we'll start with you, Lito, and then we'll go to Fukazawa-san and Paul.
Thank you very much. Marsha, can I be heard? Okay, thank you. Well, good evening, folks. Coming in here to the dinner, I was joking with some people I already know that I think you're having us for dessert. I didn't realize that is literally happening. So feel free to stand up and get your dessert. What you might hear this evening may not be as sweet as the dessert that you have on the buffet tables. But really very happy to join this panel. Unlike many of you, I am not a professional fund manager, so I am among experts. I'm more of a generalist. But perhaps having lived and worked mostly around Asia-Pacific region, I do have perspectives that I hope will be valuable to you. Just starting off with the first question, Marsha, in terms of the prospects for the Asia-Pacific region, I guess the best way to to describe my own feelings about what I'm looking at is to say that I'm cautiously optimistic. Optimistic about the future of Asia, regardless of what happens in the U.S., regardless of what happens in Europe, although certainly a strong recovery or some recovery in the U.S. and Europe will certainly be a big boost to getting that kind of growth that we've seen in Asia prior to the crisis that we've just gone through or still going through. Why do I have a cautiously optimistic point of view about Asia? I think a number of reasons. Let me start with the first one. In a way, when you think about the Asian financial crisis, you could say many things bad about the Asian financial crisis, but it certainly gave a dress rehearsal for Asia. It gave Asia the opportunity to restructure itself across many different sectors. You can look at the government sector, where many of the governments were able to correct their fiscal imbalances. Many governments were able to address the shortage of foreign exchange. Today, as many of you know, 2/3 of the world's reserves to Asian central banks. If you look at the corporate sector, and that was certainly one of the most damaged sectors from the Asian financial crisis, post-crisis, you saw a lot of companies really restructure themselves, raise equity, deleverage, and so on and so forth. So today, when you look at many of the Asian companies, these are Asian companies with very healthy profitability, healthy cash flows. In fact, prior to the crisis, many of them were giving back capital to shareholders, share buybacks, increased dividends, and so on and so forth. The fourth sector that I think also allows Asia to be very resilient facing this crisis is the banking sector. Again, one of the most damaged sectors because of the Asian financial crisis. What happened? Well, we saw rounds of consolidation almost across all countries in Asia Pacific. You saw many banks also raise equity, both core capital, tier 1, tier 2, hybrid capital. So facing this crisis, many of the Asian banks had good liquidity, reduced NPLs, fairly strong balance sheets. In fact, if you think about liquidity, I think except for one country in Asia, most Asian banking sectors had loan-to-deposit ratios of less than 100%. In many cases, 70, 60, 70, 80%. So many of the banks in Asia were funding their loan business with core, sticky customer deposits, unlike many of the Western financial institutions that relied on borrowed money. So facing this crisis, the region was already well prepared. You had strong banks, strong corporates, governments that have the flexibility to respond to the recession that we were facing. Central banks that could have very relaxed monetary policies, and governments that have the ability to provide stimulus programs without necessarily blowing out their fiscal deficits. So you've got a region that was well prepared. What else was happening in the region? If you look at the experience of job losses, I think you can understand why the psyche in Asia was a bit different from the US or Europe. I always tell my colleagues, if they're feeling so depressed in New York or London, come to Asia, it's kind of lift you up. Because even at the height of the crisis, I think, we can all feel that Asia, continued to be quite relaxed or just feeling very confident about itself and the future. And I think part of the reason is that domestic consumption continued to be strong. I mentioned about job losses. I think the Asian economies responded to the recession a bit differently from the US or many parts of Europe. If you look at the contraction in the US economy and you look at the job losses that were incurring because of the economic contraction, it's almost not the reverse, but very different experience was happening in Asia. You were losing 200,000 jobs, 300,000, 600,000 jobs in the US month after month. In Asia, on the other hand, if you look across the economies, at its worst, the unemployment rate went from 0, meaning no change in unemployment rate, maybe to -2%. Compare that to what was happening in the region. I mean, there are some very open economies in Asia, like Hong Kong, Singapore, where during the first quarter, the GDP rate, GDP was contracting, 10, 11%, and yet you were only losing that much of jobs. Singapore, where I am, they created 800,000 jobs between 2006 and 2008. First 6 months of 2009, when the economy was contracting, they lost 20,000 jobs. Asian companies, I think, responded to the recession differently. In the U.S., as you might expect, they're very, kind of grab the problem by the throat. First thing you do, you cut costs, you retrench people. That was not happening as much in Asia. One, you had governments who were providing support to companies so that they don't go belly up. Some governments were a little bit more creative. In Singapore, they were providing what they call a job credit, where for every employee that you have, who's Singaporean or permanent residents, the government was actually giving us dollars, Credit Suisse. So we were getting a subsidy from the government to keep jobs in Singapore. And so you can, you see that around the region. So the job losses in Asia were not as much as what you were experiencing in the Western world because of the recession. And that's why I think, from the trough that we've seen, industrial production actually has recovered. And it's not just because of domestic demand, which has been strong or positive, but it's also because of improving exports. This might surprise people, but actually exports across, in Asia has been improving, depending on the final destination, whether it's G3, China, or within Asia. It's just a question of when did the recovery start. In some cases, this market started recovering, beginning of the year, January, February. For the G3, perhaps a little later, maybe April or May. But exports has also been picking up, and I think this is really what you see in terms of the positive mood in Asia.
Excuse me, Lito, where do you see exports picking up?
Well, as I said, it's almost every destination. I looked at the numbers of non-Japan, non-China, Asia, and looked at the export numbers of whether it's going to the G3 economies, to China, and to within the region. And in all cases, actually, the recovery has already started.
So you're talking about intra-Asia export,
right?
As opposed to external.
Right. It also helps that inventories have been brought down. So I think that that has also helped industrial production. So as I said, I've got a cautiously optimistic view. I mean, you might say, so where does that position Asia? Well, maybe Asia during this period of recession still has had positive growth. Maybe we will not get to China growing at 11, India growing at 9, Vietnam growing at 8-9%. If the U.S. and the European economies don't recover more strongly, but even with that, I think you will continue to have doing good growth in the region.
To take it one or two steps further on the two questions, has that cautious optimism affected your strategy or your advice to clients and your perception about risk for investment, for so on?
Well, let me put on one of the roles that I play, which is on the investment banking. As Credit Suisse actually has investment banking, private banking, and asset management in the region. Investment banking, we've certainly seen a recovery in the capital markets. You've seen IPOs, converts, block trades. You've seen some bonds, beginning to happen. I mean, just in the last few weeks, you've seen some of the largest IPOs coming out of China, coming out of Malaysia, Singapore, and so on. So we've seen, a return of our business. It's certainly not yet quite to the same levels as what we saw in 2006, early part of 2007, but we're seeing some recovery. On the private banking side, we also start seeing clients shifting their portfolios from, pre-crisis, very little cash to, middle of the crisis, lots of cash, and now it's moving back again to, being reinvested back into the markets. So that's what's happening on the private banking side. Risk, yeah, of course, I think, as I said, I'm not fully optimistic. I'm cautiously optimistic because there are still a lot of challenges, in front of us. Certainly, a very lethargic or no recovery in the West will tend to dampen the level of growth that we will see in the region. Questions about valuations, whether the financial markets in Asia perhaps may have gotten too far, too fast, too quickly. So, questions on valuation. But the fundamentals, I think, are relatively sound.
Mm-hmm. And just before we go to Fukazawa-san, which economy, I mean, is this cautious optimism the result? I mean, you said the fundamentals are in place for many of these economies, but is it also the fact that they're existing sort of in the downdraft from the Chinese economy, forward momentum? Is that a key driver in your opinion?
Well, China certainly has been an anchor for the optimism and the stronger performance out of Asia. I think as you went through the crisis, you really see a difference in experience. You've got very open economies like Hong Kong, Singapore, to some extent Taiwan, Malaysia, and Thailand, with more percentage of their GDP coming out of exports that suffered very substantial contraction. On the other hand, you've got economies that are much more domestically driven, and surprisingly, China is on that camp, where on a net export, when you take away the import component of their exports, it's probably less than 20% of their economy is net export dependent. And you have countries like Vietnam, Indonesia, India, Philippines, that continue to enjoy positive growth. Now, on the rebound, as the economies are recovering, I think you're seeing the reverse, where the more open economies are experiencing a sharper bounce than the more domestically driven economies. So Singapore, for example, in the third quarter, had a very impressive rebound. And I think you will see that in the open economies going forward.
Fukazawa-san?
Yeah. Thank you, Marsha. Good evening. Tonight, I would like to mention how I'm going to see Asia from a Japanese private sector's point of view. When I got the discussion point from Marsha, one thing I remind me is that I think it was 1981 when Prime Minister Mahathir of Malaysia said, let's look east. Means let's take a lesson from Korea and Japan's success. Now I think for Japanese point of view, let's look west. West means not Western countries, but west of Japan means like China or India. And like everybody is talking about, there are still many things that from Japanese point of view, we have not yet cultivated into this Asian market. And one thing is, for example, population-wise, if we include ASEAN 10 and China, India, Korea, Japan, Australia, and New Zealand, maybe this region's population is about 3.3 billion, which is 50% of global population. So we have a lot of people. And the total GDP in that area is about 15 trillion US dollars. It is somewhat the same that of EU and NAFTA, I mean US, Canada, and Mexico. But quite different thing is GDP per capita. Asian, those 16 countries, GDP per capita is still 4,000. And that of EU is something like 37,000, and that of NAFTA is 38,000. So there is still a huge gap. So we recognize this huge gap is a kind of, say, room for growth. That is what I say, look for West. And as Rito-san mentioned, that even after Lehman shock, such countries like China and India still positive growth of GDP. And ASEAN 10, even though they make a minus economic growth, but their minus is just 0.3%. So it's very small to compare to that of, say, Japan's minus 3.3%, EU's 4.8% minus, and US is minus 2.6%. This is based on IMF's prediction of economic growth of this year. So Asia, including China and India, still keep strong pace of the growth. So that is unless we see a recovery of the US or European side, this is where Japan should concentrate. And I have one thing, interesting figure that I would like to share with you because this is dinner time. That is, actually I borrowed that figure from Mr. Tamaki, who is a high-rank officer of the Ministry of Finance of Japan and happened to be a brother of Mr. Tamaki of GPIF. That is champagne import by country by country. I got this figure from homepage of Comité Champagne. That is figure is a calendar year of 2008. And the French champagne export to other countries decreased by 6.4% last year. And do you know who is the largest importer of champagne from France? UK. Congratulations, John Campbellson. Actually, UK is the largest importer, and second is US, and the UK's import bottle, 36 million, is more than double of that of US. So UK is the largest contributor to French export. But still, last year, UK's imports of champagne is decreased by 7.9%, and USA's import decreased by 20.9%. And third country, Germany, again, lost 10.4%. And Japan comes to the sixth and largest importer of champagne in Asian country, but still we have minus 9.1%. Then Asian miracle comes. Australia, John, even you have a very good local wine, but you are the ninth largest importer of champagne. And last year, even after Lehman shock, Australian import champagne increased by 10.2%. And you overtake Netherlands and ranked from 10th to 9th. Then Hong Kong. You raised from 19th to 17th and increased 13.8%. And then China. Wow. You raised your ranking from 23rd to 18th and increased by 30.7%. So I think this is what we call decoupling. So, serious discussion. Japan look Asian country, China, Vietnam, Thailand, and Indonesia, Philippines, as, say, home of production so far. But from now on, that big amount of consumption and also the raising of the middle class income people, Japan is now aiming for, looking for Asia as a consuming home ground. Even though at this moment, America, USA is the largest trade partner of Japan. 18% of export is to USA, and that is not including indirect export from Asian country to US. So including that, US is still largest and very important, most important trade partner for Japan. But this does not include the export of Matsui Hideki of Yankees, who got MVP of World Series today. And,
I didn't know.
So still US is a best partner, but those kind of, say, middle class number in Asia has been increased. Japanese company need to think about, private sector, think how to penetrating into consumers in local market here in Asia. Again, I put one statistics. Actually, I got this from Nomura Research Institute. that say number of say household whose disposable income is between 5,000 US dollar to 35,000 in Asia, say about 11 countries, not including Japan nor Australia, was about 140 million in year 1990, and that has increased dramatically to 880 million last year, 2008. So amazing 6.3 times increase. So this volume zone is where Japanese manufacturer is going to aim to, not only Japanese, but many developed countries, private sector is going to penetrate into. And so Japanese has been very good at to say export, transfer, production plants, say here in Bangkok, elsewhere in Asian countries. But we are not so much good at so far to bring Japanese goods into Asian countries. So there are, I think, 3 points that we should consider to be really good partner as a consumer producer here in Asian countries. One is product fitting for that local market, because Japanese sometimes over quality makes too good products, which sometimes might not fitting for local people's say request. So too expensive, but too quality doesn't fit some of the product, like Japanese handset of a mobile. Too many kind of a gadget is included, but it isn't so much popular in Asian countries. And alliance with local partner, this has been done, but when it comes to the local marketing, then it is localization really how to think about, how to penetrate into local people's mind is necessary with collaboration with local partners. I think those things we need to reiterate and thinking about from the scratch how to penetrate into Asian market. But stock market has already kind of reflecting and choosing among Japanese companies who is good at to making that of a local penetration as a relatively, say, good performance in stock exchange. For example, Shiseido, as you may know, Japanese leading cosmetic manufacturer, their last year's fiscal figure mentioned that their sales, already 10% of the sales of last fiscal year comes from China. And 25% of operating profit come from China. And Goldman Sachs analysts predict Shiseido's sales come from Chinese market, maybe in 10 years terms, 25 to 35% of Shiseido. And operating profit-wise, it's more than 50%. So Shiseido is really committed to getting into local good partner for Shiseido. Such other company like, say, baby-related manufacturer, like Unichan, which is equivalent of Japanese Procter & Gamble, paper diaper manufacturer, and Pigeon, which is very good at, say, baby milk products, are also committed to getting into a local partner, not only in China, but in India and Vietnam. So those are areas where Japanese private sector is looking for as an Asian market. So as a private equity manager, and the Tokyo Marine Capital is a mid-sized cap private equity general partner, and we have just made an investment in Japan. So how can we make our investment vis-a-vis those look for West scenario? And when we're thinking about these days in our investment, we think about that in that aspect twofolds. One is, again, to what extent our investment portfolio company could have a room to getting into Asian countries' market. For example, one of our portfolio company there's a company called Mickey House, which is a leading Japanese apparel for kids. I think some of you might find it somewhere in Hong Kong, but that's very, very expensive. Even T-shirts for toddler cost us 70 or 80 US dollars. But that is sold in Shanghai's very exclusive boutique. Price tag is easily 100 US dollars. But there's still some consumption is there because even though the percentage of rich people in China is very small, but number itself is very big one. So that is the area where we choose or we are trying to finding out where is a good Japanese opportunity as a private equity investors. And the other way of second point that we would like to think about is exit strategy. I mean, exit means how we sell our portfolio company. And we're thinking about whether the investment company to which we make an investment is get any attraction from Asian companies. And that is sometimes occurs because last December, it happened to be that one of our portfolio companies, just after 3 months of Lehman shock, purchased by here Thailand company. They are producer of fitting for steel piping. And the Thailand company manufacturing piping for oil transportation. So literally, they are good fitting. But because the Japanese company has a very world-renowned technology, so even after the, say, economic crisis, that company has attraction from the interest from Asian companies. So those two aspects that we consider as additional kind of aspects, important points when we choose the company to make an investment.
Mm-hmm. So just so I understand, Fukazawa-san, the retail sector would be a focus, but the retail sector that's manufacturing Japanese goods with a market in China or other parts of Asia, is that a key focus then for you?
At this moment.
At this moment. Yeah, it seems like the two of you then would agree that that intra-Asian market is what's either the short-term future or maybe long-term future too. I wonder if we might come to you, Paul. We've had some analysis here from a PE investor, from an investment banker. You're in the position of having to implement against these circumstances or in step with these circumstances. Do you share that same cautious optimism that Lito talked about and that Fukazawa-san seems to talk about too? How do you put things together for yourself and for the fund?
Sure. Well, thank you. I mean, really, I've got nothing additional to offer there. But you know, one of the wonderful benefits about Australia is that people are cautiously optimistic at most times. But being the backyard of China makes it an especially relaxed place to be. And so I have to say, from our perspective, you know, bearing in mind that over the last few years, my own energy has been very much devoted to trying to get a new organisation up and running. You know, it has been, it is somewhat reassuring and to be sort of at the tail end of the energy and the development and the focus that is occurring within Asia. We don't, it may be unfashionable, we don't yet think about Asia, about an Asian theme particularly. I mean, the world's a big place and capital can go any which way, and so we don't spend a lot of energy thinking about the role of Asia within that, except that we very much focus on kind of what Asia, in our general approach is. We tend to use currency as a proxy for developing Asia. We at this stage feel not certain enough about our approach. I mean, we have exposure within Asia, both within the listed market, within the private equity market, and elsewhere. But it's still, for an organisation like us, and this may well just be a stage of development, we're not yet certain enough of the rules beyond that. I think that's an issue for many institutional investors. There are war stories galore of people who have tried different strategies within Asia more broadly and perhaps within China particularly. And so our own approach has really been to try and participate in that growth through using hopefully a re-rating of those currencies as a proxy for that growth, and otherwise investing through more conventional means. So we definitely share that optimism. Close to home, we benefit from that. But in contrast to the others, I don't spend a lot of energy, and people in our organisation don't spend a great deal of energy focusing on kind of tracking different trends within Asia. We're really trying to hold our own within a broader world with, there's bigger waves washing over the rest of the world that we're trying to kind of hold our head up above, rather than particularly trying to focus on how to skirt the issues within Asia.
Well, I was looking at your asset allocation, and it had the date September 30th, 2009, so it's fairly current. But it's 32% cash, 24% debt securities, 23% global equities, 11% Australia equities, 5% alternative, and 2% each infrastructure, property, and private equity. Did that change at all, Paul, in reaction to what happened last 18 months or the preceding 18 months?
Sure. I guess there's two things I'd say, and I was saying this today. I mean, life is complicated enough as an investor, and we decided one thing we would do was trying to keep it pretty simple in our place. So we took a very deliberate step of thinking about our portfolio in a really in four quite manageable allocations, and there was two reasons for that. One is, it does make it easier for simple folk to work with a smaller number of moving parts. The second, of course, is that, as I think any institutional investor would recognise, sometimes the very best opportunities lie between the cracks, and I think it's a great lament on institutional investors generally that we've organised ourselves in such a way that we find ourselves unable to participate in that. So, and I think, it's important to point out that the fact that 1/3 of this fund is in cash is really a reflection of the fact that only a little over 24 months ago, 100% of it was in cash. And, this is
I remembered that.
Yeah. So, and this was an organisation with essentially one person to start. So, that's a product of the journey. Did our journey change? Absolutely. So, one benefit of trying to keep the program quite simple is it was a very easy call for us to hold a lot less equity than we might have, and we think about equity in both a public and private context, and to hold a lot more credit. And so, this fund was much more credit heavy, particularly focused on distressed opportunities. It's been the strongest returning sector for us, ahead of equity, public and private. So there was definitely a shift of allocation. Our aim would be to have around 1/3 of our program in real assets. That's if you're talking about a kind of a $20 or $30 billion program, that takes a long time to build. So those numbers are really a function of our stage of life. But to answer the specific question, absolutely a focus on credit opportunities, a move away from equity opportunities, particularly a focus on trying to build exposure at a time when the private equity world was pretty much deserted of LPs. It seemed like a great chance for us to participate in that, and I was chatting with people today around our experience there. So it's a slightly different perspective. Asia is part of that, but our approach, as with most things in life, we're interested in using agents who can do a lot of that work for us. We figure it's a helpful position to be one step removed, seeing what's working and what's not, going in after that in a more focused way with the benefit of that experience.
I'm curious about this Asia story. I mean, I understand it's a new fund. You started in 2006, is that right? 2006, and it's where you are at this point in that Asian story. And I wonder if I might just ask maybe Bob Maynard and Priya. Bob, I know his explanation of keeping it very simple and straightforward would resonate with you, but that idea of an Asian story, Bob being a smaller fund and Priya with CalPERS, a larger fund, does that Asian story piece of it, lack of it or the need for it, does that resonate with you, and how do you parse that, I guess, is what I'm asking.
Well, this does resonate. My understanding is that CalPERS is going to go like Idaho to a staff of 2. and make it very simple and just make it all one thing. So I'm going to defer, as usual, to Priya for the response to that question. Where is Priya at the moment? There we go. No, you're going to reduce your staff down to Joe and one other person and Faruqi and go the Australian route. It's yeah, we do it very simply. We agree with Paul's approach. But I'm going to, now that Priya's mic is working, as usual, I kick the ball to her.
Well, just because we have 100 times the staff that you have does not mean that I know anything more than you know. And actually, Faruqi probably would be a better person to answer this question than I would. I don't know if I should punt it over. You know, I think we remain very interested in Asia, and that interest has been growing over the past several years. The way that we've been investing in the emerging markets has really been sort of pan-emerging market funds or pan-regional funds. And so I think looking forward, we might look at some more deeper dives into various countries and how to take advantage of some really good on-the-ground knowledge and relationships. So I think that might be in the future. We certainly believe, I mean, one thing we learned last year was that there really is, that diversification is a challenge, that the correlations in some fiscal times can revert to one or close to one. And so, you know, emerging markets, we still continue to look to emerging markets to add some of that diversification, and we hope that is possible.
I wonder if I might.
I always defer first to Priya. Then I do have a comment about this. So
now he wants to do the counterpoint. Should we just keep going like this, Bob?
Yeah, I think we should. Yeah, actually. One of the things, the way our fund works, is that we only make, whether they're making 50 or 60 bets, we make 5 or 6, and we stick with them. And one of them is emerging markets, and one of them is Asia. So approximately right now, Rochelle can correct me, and she always does, and she actually is the one who runs the fund. We have about 15 to 16% of the total fund in emerging markets equity. And that's been that has gone from 10, and we're about now at our high, because when we rebalanced the last couple of years, we rebalanced to Jeff's area, REITs, and emerging markets. And right now, that actually worked out fairly well the last year. The issue in the longer term is not so much the emerging market story and the emerging market growth. It's a question of how do you invest in it, whether you do it public or private. And I think that is still something that we take as a matter of faith, that the emerging markets will be a place to be. And I'm deferring for the moment the question on emerging markets, whether it's the resource-rich companies of Brazil and South America versus Asia. But it seems to us that public has tended to be a bit better than private over the years. The private success has tended to be anecdotal and sporadic, and the public success has been a bit more consistent over the last 20 years or 30 years. So I think that jury's still out. But we agree with Paul's approach. We agree with an emerging market emphasis. It's one of our 5 major emphases in our fund, and it's going to be there for a few decades to come.
Lito, on that subject of public versus private, China just opened ChiNext exchange. Shenzhen Gem Exchange has been open a little bit longer. Is that landscape changing for private equity, improving? What's your take on public versus private in this emerging market in Asia?
Right. I think it's important to recognize that Asia is a very diverse landscape in the financial markets, and there are economies that are very advanced with very advanced financial markets, capital markets, and I think to some extent that kind of dictates also that has an influence on this issue about public versus private. One of the continuing challenges for Asia is the issue of governance, regulatory issues, the predictability of of policies, and so on. And And so it's very difficult to have a general approach of public or private. In some cases, public markets, the only way you can have predictable outcomes. The private side might be a bit more unpredictable, especially in economies where the rules of the game are not so clear. It's very difficult to give a very general comment. I think it's country by country.
Mm-hmm. Howard Chow is in the audience. There he is. And Howard heads the China practice for Melvin and Myers. I wonder if you might give us a sense for the outlook on private equity in China. Howard, what has changed? What is changing? What are the obstacles?
Okay. I think we
in
talked.
brief.
Thank you, Marsha. We talked a little bit about this in the panel, the breakout session this afternoon. But let me just say a little bit more about that generally. And to put this in a larger context, many of us in this room are purveyors of capital, shall we say, and just speaking about developing Asia, or emerging Asia, it used to be 25 years ago that those countries were very capital poor countries. Today, as we all know, listening to many of the speakers today, 2/3 of the foreign currency reserves of the world reside in Asia. These are capital-rich countries. Just to give you a little anecdote, in 1978, I was an exchange student sitting in Geneva, and I had a classmate who was one of the first Chinese legal scholars, exchange students coming to abroad to study law. Now a famous professor of law in China, by the way. And he arrived in Geneva about the time I did, and I asked him how he got. How did you arrive? How was your arrival? He told me that when he arrived, he had $5 in his pocket, and I said, "Well, gee, how were you planning to get from Zurich to Geneva?" And he said, "Well, I didn't really have a plan, but that was all that the bank in China was willing to give me in foreign currency. It was $5. And so I met an embassy official, fortunately on the airplane, that put me up at the night in Zurich and then gave me a ride to Geneva the next day. But that was 1978, okay? Now fast forward to today, where China has foreign currency reserves of $2.3 trillion, and I suspect that same professor would not have trouble getting the expenses from Zurich to Geneva. So putting things in that context, I guess one of the points I would make about foreign private equity in China is that this is no longer a country that actually really needs a lot of foreign capital coming into it. And so it is a country where in fact, it's flush with its own capital, not only foreign currency reserve, but its own domestic capital, and where our dollars or euros or yen are going to be competing with renminbi in finding those investments. And guess what? When you're looking for Chinese investments, who is going to have a home court advantage in both sourcing the deals and in finding funding and getting approvals and all of the things that are normal factors in success in private equity. So I'm laying out a little bit of the context of why I think renminbi funds and private equity in China is changing very fast, and why we ought to be thinking about it in much more of a macro and strategic way than just thinking about, is a renminbi fund the right vehicle, or how am I going to do my exit? Because I think this is in the context of why am I relevant to the China market? Why should my money be accepted there? Why will I have a competitive advantage? How can I find partners? We talked about local partners today. How will I find local partners that can continue to make me relevant in China? Because if I just go in there by myself, is that going to be difficult? I'm not trying to paint this as an absolute problem. Okay, I'm painting more of the challenge that we're going to increasingly face as the domestic industry in both China and other emerging markets in Asia grow up, and as they are able to manage their own capital resources that they have with their own talent, whether returning home from abroad or homegrown, all of those are going to be challenges for the international private equity community.
Yeah, thank you, Howard. So Japan, China, I wonder, Nick Morris, you're back over here. I wonder if you might have a comment or two, because you're not only looking at Asia, you're looking at other parts of the world as well. And then we'll come back to you, Lito, what countries you think are, how you might see the countries rank one another. Yeah, please.
Yeah, I mean, I agree with the panel's general view of cautious optimism regarding Asia. I wish I could say the same about Europe, and I don't think I can. Actually, I think Britain's long-established role as lead champagne drinker may have been for celebratory reasons once, but it's also a great drink, champagne, when you're having troubles. But no, I mean, I think that my group basically has a global perspective on private equity, and that's not, but in fact, having said that, about 70% goes into Asia, because I think that's just where much of the activity is. Having said that, a healthy 30% is actually elsewhere. And, you know, there are pockets of great excellence. Picking up Bob's comment about the sort of the jury being out, as it were, between public and private equity in emerging markets, I have a total sympathy with that if you look at the historical context. But if you actually sort of go back sort of 10 years or 10 years plus on this, I think you'll find, you know, emerging markets are dramatically different from 10 years ago. I mean, you're talking, you know, at a macroeconomic level, a political level, major, major differences. You know, the crisis in emerging markets in the late 90s was very much a sort of an emerging market-inspired crisis. The recent crisis we've had absolutely is not. And I think just in terms of sort of whole areas of, you know, responsible investing, corporate governance, the usual sort of things that we like to talk about now, you know, we're seeing a tremendous sort of increase in standards in emerging markets generally. So, I mean, I think that if you actually go back, say, 5 years rather than necessarily 10 years, I think you'll find that actually the record of between public and private is quite attractive. I mean, realizations are a problem everywhere, including the West. So, I mean, today, you know, I'm not suggesting that emerging markets are necessarily a better place to be than developed markets in private equity, although privately I think that. But you know, the empirical evidence wouldn't necessarily suggest that. But and also, in fact, if you look at the sort of the massive drop in the public stock markets in emerging markets, if you go back over the last 5 months, then clearly investing in public equities in emerging markets would have been a great bet, particularly given there are no distributions in private equity. So, you know, but I think that's just a sort of kind of a snapshot. So, I mean, I think that, you know, Brazil, we're very happy with Brazil. We like, actually, we haven't in the last 2 years made any fund investment in Central and Eastern Europe, because I think it was bad, it suffered very badly, particularly on the financial side. But for that very same reason, I think it's a terrific bet for the next 2 or 3 years going forward. So, I mean, I think it's very much a sort of a case-by-case regional basis. Having said that, I still think Asia has a tremendous opportunity for us, certainly in private equity. So, you know, we're actually pretty cautiously optimistic, not just in Asia, but also in other private equity markets.
Well, Lito, you've got several people behind you on the cautious optimism. I wonder if you might look at the region, and then we'll come to the audience. Your questions or your comments, we have a few minutes left, and I hope I haven't given any of you short shrift. But Lito, if you look across the region, give us your sense of which countries which economies you're looking at, and which ones you think might be moving faster than others.
I think they're probably interesting to look at them from either a country perspective or a sectoral perspective, because I think there are stories on both sides. I think on the country side, the obvious ones are the high growth countries. So you've got places like China, India, the most obvious ones. Vietnam, I think, is one that's been able. Indonesia, I think, is the one that's emerging, and certainly the political developments in Indonesia, I think, makes it even more compelling, because now you have at least another 5 years, hopefully, of political stability with a fairly competent, government, which I think will transform. Has the potential of transforming that economy. And then you've got a few small economies. I mean, some economies you never don't hear about. I mean, Cambodia. Cambodia is probably one of the economies in Asia that has probably kept at pace in terms of growth rates with places like China and Vietnam, except it's so small. Mongolia, just the stories around minerals in Mongolia. I think it's probably one of those countries that might just surprise people. It's a one product economy, minerals. But you could have a situation like the Middle East or Brunei and other oil-producing countries, except that in their case it's gold, it's ore, it's iron ore, it's copper, it's gold. It's probably easier to look at the sectors because if you look at the trends that have been mentioned here, you've got growing middle class, continuing growth, et cetera, et cetera. There are some sectors that are screaming, saying, we will be an exciting sector. Infrastructure. The region is very much an underbuilt region. So the demand for infrastructure in all forms is just tremendous across the region. You've got the growing middle class, so consumer products. You've got large populations that are still relatively homeless or underhoused. So, low-cost, medium-cost housing, in China, in India, in Vietnam, Indonesia. You have, in some cases, surprisingly aging population. Not only in Japan, but even places like China. So, healthcare, medical services. Many of the economies in Asia don't have sufficient safety nets. So, pension fund management. Asia needs to transform itself as an economic region, less export dependent, much more domestically dependent. Reduce the savings rates in many of the economies, and a big challenge for that is really creating the safety nets. Providing pension, insurance. So I think financial services, asset management. I mean, businesses that are represented in this room, I think are going to be exciting sectors in the region.
Questions or comments in the audience?
Just maybe picking up a comment that Howard had mentioned, also thinking through some of the topic of your discussion in investments in the changing landscape. And when you put on the mindset or framework of, as we feel that the landscape is changing in Asia, and we put on the mindset of asset allocation in a traditional fund, and we sort of look at how we put our assets together and how we allocate our assets and the risks and so on. When we look at a traditional sort of core satellite type of asset allocation, we try to allocate some of for example, you have core, you have US, big, large, deep markets, and then you have satellites, you have the other smaller countries. And in a sense, would that mindset basically push the investor to kind of like higher risk, smaller allocation, but higher risk assets? So if you put Asia into this category, then you're basically pushing Asia as an investor set into a higher yielding, hence higher riskier asset level. Okay. Now going back to what Howard was saying earlier about as Asia starts to grow, there'll be more folks chasing yields or chasing assets, and the higher quality assets, there'll be higher demand, and then there is supply. So, but for investors who are outside of Asia trying to get in, and they have this mindset that would they then be, in a sense, be pushed towards more of the riskier assets, because in a sense, the lower yielding assets, the higher quality assets, in a sense, taken away. Right. So when we talk about the changing landscape, we talk about on the asset side. But also, I think there has to be changes. Maybe there are the comments here from some maybe the consultants' side who can comment about some of the asset allocation processes in this changing landscape.
Care to respond? How about in the audience?
Yeah, my name is Faruqi from CalPERS. One of the phenomena that we see in the creation of bubbles over the last several decades is the fact that I think they seem to be occurring now in increasing frequency. And part of this is due to the rapidity of the flow of capital across global markets, chasing what's the next opportunity and so on. So it seems to me emerging markets would likely be the next candidate for the next bubble. Do you have any thoughts on that? And do you think what is in place to prevent that and so on?
I think it's a very valid concern. And it's really the point that was made earlier. I think it was Howard and someone else. I mean, too much money chasing the same assets, in fact, very few assets. So the risk of an asset bubble, I think, is there in emerging markets. I do think that particularly because of the crisis that we've gone through, a lot of lessons hopefully have been learned, and we will not put to waste, the crisis that we just went through. If you hear the policymakers around the region, I think there's a very strong sense, a lot of sensitivity to asset bubbles. Real estate, for example, and you already see some of the governments in Asia responding to the sharp rebound in real estate prices. I mean, again, I come from Singapore, so I see a lot of that, and you see the Singapore government responding to the sharp rise in prices of real estate. I think in China, the same. One, you've got policymakers that I think are much more attuned to the risk of asset bubbles. In fact, you could have the reverse situation. Many governments in Asia are now beginning to be concerned again about portfolio money and how that creates the asset bubbles. And hopefully it will not happen, but to some extent, to the extent that they will start restraining the inflow of capital, I think that's a risk that certainly this room should be concerned about, because that might limit the opportunities that become available to you. And then you've got the ability of governments to use monetary policy. I think that's clearly we are in an era of such low interest rates. And concern not only of asset bubbles but inflation is certainly at the back of the minds of many policy makers, the central bankers. And while I believe that at least in the foreseeable future, and I mean next 6 to 12 months, I think they will still tend to be defensive in that they will be much more concerned about sustainability of economic recovery versus inflation. But I think the back of the mind, of many central bankers, policymakers, is to make sure that on the other hand, you don't have a situation where asset valuations go crazy and inflation sets in. So I think there will be natural breaks to prevent asset bubbles. Now, human beings are human beings, and greed takes over. And of course, as we know over history of business and commerce, asset bubbles do come up. And as you pointed out, they've become shorter and shorter. But I'm basing it on the hope of enlightened policymakers to provide us the brakes when the markets get out of control.
You're not worried about that in the short term?
Not in the short term.
Fukazawa-san, do you have anything to add to that?
Yeah, Japan has a issue of bubble about 10 years before, and
Small bubble.
U.S. and Europe has last year. And I was attending the conference of U.S. and Japan financial symposium end of last month, which main theme is how U.S. should get lesson from the failure of Japan 10 years before. So as Ito-san mentioned, that there are so many lessons. I mean, that burn which Japan has suffered is not yet, fully recovered. So we have still, in our mind, some of the pain. So unless until that is remaining in, not only for us, but the mind of in central government and the politician, and also, for example, Chinese government. I think I haven't met with them, but one of the main feature is to get the lesson from Japan, because they are, how should I say, very clever enough to thinking about this might be the starting of the green shoot of a bubble. Is that, I don't know how to say it.
Coined a new phrase.
Yeah. But so by that regards, they are thinking about the study of the Japan situation, because the difference between Japan and the U.S. is, as you remember, it's November in the U.S. collapse of Lehman Brothers and taken over Merrill Lynch by Bank of America, bailout of AIG, and those things just happened very, very short time period. So that means U.S. needs a very, prompt, all of a sudden type of approach. Whereas in Japanese case, Japan's bubbles burst starting as early as 1994 or 5. That is started from the debacle of so-called Jusen. It's a bank-affiliated mortgage lending companies collapse. That's lasted until 2003 when Risona Bank is nationalized by that time Koizumi government. So it's at least 7 years or 8 years prolonged history of a bubble burst. So Chinese government might be thinking their kind of a potential problem is rather than not similar to US, but might be similar to that of Japan. So as far as those studies taken, I think that might happen, but the impact of the bubble burst might not be so severe as we had last year.
But I think that it's incorrect to just look at Wall Street, because I think what we went through is a combination. I describe it as an intoxicating but explosive cocktail, and I think certainly Wall Street has to answer for some of that. Providing the rock scientists that created just complexity in financial instruments that tend to blur risk and rewards for short-term profits and short-term compensation. But certainly investors that were seeking higher yields because interest rates were so low for such a long period of time. The demand for, you ask for high yield, we give you high yield, and issuers, who with low cost of capital, start looking at projects, credits that are probably below standards. You look for them, Wall Street gives them to you. And then you've got regulators who, for the most part, I think have been left behind by all the developments in the financial industry. You've got lawyers trying to understand derivatives. You have, regulatory agencies that can't pay, enough to be able to bring in talent that can actually appreciate, understand, and regulate effectively, new financial institutions, new financial instruments, and everything that we've seen happen. So, I think you can point many fingers, sort of around any room, and I think you'd probably be correct in terms of what caused this bubble. I think the bubble was created out of long period of low interest rates, low inflation, excessive liquidity that created, as I said, this intoxicating but explosive cocktail.
It seems to me that we're going to be trying to sort it out for months and months. Really, the change has been so sweeping, as Fred Hood noted this morning. Join me in thanking these three gentlemen. They've been just terrific.